After 7 straight weeks of gains, EU allowance prices lost some steam in June, trading sideways between 70 and 75 euros. Short-term news like Trump's renewed tariff threats, Israel's brief war with Iran, and the corrosion at a French nuclear reactor drove most of the price action. Beyond the noise, two fundamental signals stood out. First, the long-anticipated decoupling between EUA prices and gas prices. At the start of June, EUA prices were still tracking gas very closely, with a correlation above 0.8. But as the month went on, that correlation dropped sharply, even turning negative. Why? Well, summer dynamics took over. Gas demand is now driven more by storage needs ahead of winter than electricity production, in spite of cooling demand from early summer heat waves. Meanwhile, renewable production stepped up with strong wind and solar output, which pushed out fossil fuel emissions. Second, long-term investor confidence is back on the table. Investment funds, which had exited the market after April's crash, are now rebuilding net long positions. These positions tend to be predictive of future price direction, as recently demonstrated by some academic studies. Banks like Citi and Macquarie also revised their EUA forecast upwards, with targets as high as the mid-90s by 2026. For private investors, this is what matters, separating long-term fundamentals from short-term news-driven volatility. With prices still below their 2025 fair value, now might be a smart time to start building or reinforcing your position. And for those who want the full story with all of the details, our June price report breaks it down. Don't hesitate to reach out and we'll send it to your inbox.